At the end of every month, I sit down with my spreadsheet to track exactly where my portfolio stands. I log every share bought, every dividend received, and update my cost basis and overall performance. I then take all that raw data and plug it into infographics so you can see the numbers in a way that actually makes sense. Beyond keeping this as a digital diary, the goal here is total transparency. In the finance space, it's common to see creators only highlight hype stocks or massive wins while burying their losses. I want to show the full picture, the good, the bad, and the boring. If you value that kind of honesty and want to join a community where we grow our wealth together, consider subscribing and liking this video. It really helps the channel reach more people. Let's dive in. Before we get into the April numbers, I want to step back and look at the trajectory of this portfolio. It's easy to get caught up in the month-to-month noise, but when you look at the yearly growth, the power of consistency really starts to show. In 2020, I started with just $1,835. By 2022, we hit nearly $10,000, and standing here today in April 2026, the portfolio is sitting at $37,931. Seeing that jump from $33,000 at the end of last year to nearly $38,000 year to date is a reminder that the boring work of dividend growth investing actually compounds. We aren't just chasing hype, we're building a foundation. Right now, the weighted dividend yield of the portfolio is sitting at 2.30%. I know some people out there chase 8% or 10% yields, but for my strategy, 2.3% represents a balance of safety and growth. These are companies that aren't just paying me, they're raising their dividends year after year. Because of that, my PADI or projected annual dividend income has hit $701. That is $701 of passive income coming in this year whether I wake up or not. When you break that down, it's about $58 a month on average. It may not pay the mortgage yet, but it's officially enough to cover a few utility bills, or more importantly, to be reinvested back into the market to buy even more shares. One of the things I track every single month is how my dividend growth strategy stacks up against the broader market. It's easy to feel like a genius when everything is green, but the real test is how the portfolio handles volatility. Looking at the first 4 months of 2026, it's been a bit of a roller coaster. In January, we started with 1.81% gain, slightly edging out the S&P's 1.14%. February was even better. While the market dipped into the red at minus 0.31, my portfolio actually climbed to 3.30%. That's exactly why I love dividend stocks. They often provide that extra layer of defense when the rest of the market starts to stumble. Then came March. It was a rough month for everyone. The S&P took a massive hit, dropping 7.73%. My portfolio wasn't immune. I ended the month down 5.50%. Seeing that red on the spreadsheet is never fun, but again, because of the quality of the companies I hold, I managed to fall less than the market. Protecting your downside is just as important as capturing the upside. Finally, in April, we saw a nice recovery. The market bounced back to 5.07% gain, and my portfolio followed closely behind at 4.26%. Even though I didn't quite catch the full S&P rally this month, the slow and steady approach is doing exactly what it's supposed to do, keeping me in the game without the heart-stopping volatility of the tech-heavy indices. When you look at the allocation, you'll see why the portfolio behaves the way it does. My top holdings aren't just random picks. They are high-quality compounders like Alphabet, Microsoft, S&P Global, and Visa. I also built a defensive stance with companies like Hershey's, Kroger, Colgate, and Procter & Gamble. These are the holdings that help us beat the market back in February and March when things were getting shaky. This month, the tech sector really powered the market's recovery. My largest position, Google, had a massive run up nearly 30% in April alone, which provided a huge tailwind for the entire portfolio. We also saw strength from Texas Instruments, which surged over 40% this month after reporting strong earnings. While I have dividend stalwarts like Johnson & Johnson and Pepsi to keep things stable, it was these growth-oriented dividend payers that allow us to capture a 4.26% gain for the month. Even with tech leading the way, my main focus is on the income and growth of that income. Whether it's JP Morgan at nearly 5% of their portfolio or my smaller positions in Procter & Gamble, every share is a brick in the wall as we head towards to that 100K milestone. I'm happy with where the allocation stands. It's balanced enough to survive the dips, but aggressive enough to catch the rallies. Even though the portfolio saw some great growth this month, I didn't sit on my hands. I put my capital back to work in 4 of my high conviction quality holdings. This month, I added $1.2 0.12 shares of ADP, 0.64 shares of S&P Global, 0.46 shares of Microsoft, and 0.06 shares of MasterCard. These aren't massive flashy buys, but that's the point. Whether I'm buying a full share or a fraction, the goal is to keep increasing my ownership in companies that dominate their respective industries. There's a specific reason I target these for in April. Talking about ADP, I have this rule where if the stock price of the company goes down but the fundamentals goes up, it is a buy in my book. This happened with Google and now it's happening with ADP. Every dip below $200 a share, I buy a tranche. Don't want to be overweight in this holding, but also don't want to miss any opportunity. Then you have Microsoft and MasterCard. Microsoft just reported a third quarter with revenue up 18%, largely fueled by their AI and cloud strength. By adding to these positions, I'm not just buying a dividend, I'm buying into companies that literally building the future of the economy. And finally, adding to S&P Global, they are the ones who rate the depth and provide the data for the entire financial world. When the market is volatile like it was in March and April, people need their data more than ever. Every one of these fractional shares increases that $701 projected annual dividend we talked earlier about. It's not about timing the bottom, it's about time in the market. By adding to these winners while they are showing strength, I'm ensuring that my wealth quest stays on track for that 100K milestone. Now for the best part of the month, the actual cash flow. In April, 4 companies cut me a check, proving that the engine we talked about earlier is running exactly as it should. Here's the breakdown of who paid me this month. Automatic Data Processing, $16.92. JP Morgan Chase, $8.93. Realty Income, $5.93. And Nike, $5.64. That brings the April total to $37.42 in completely passive income. $37 might not seem like a lot to some people, but in the context of Wealth Quest is huge. That money didn't require me to trade my time for a paycheck. It's seed money that is already being funneled back into the market to buy more shares of the companies I mentioned earlier, like that extra bit of Microsoft and S&P Global. To really understand why I stick to this plan, you have to look at the history. I went back into my spreadsheet to see every April payday since I started this journey in 2020, and the growth is incredible. 2020, 90 cents, 2021, $4.89, 2022, $7.02, 2023, $10.61, 2024, $29.15, 2025, $21.39, a slight dip due to the rebalancing of the portfolio, and 2026, $37.42. In 6 years, I gone from making 90 cents to making enough to cover a decent lunch. This is the snowball effect in a nutshell. Now, for clarification purposes, April is one of my low-paying months. You'll notice that 2026 is officially my highest April on record. Crossing that $30 mark for the month is a huge psychological win. Even though 2025 saw a small dip because I was cleaning up the portfolio and moving away from yield traps, the recovery in 2026 shows that focusing on quality dividend growers like ADP and JP Morgan was the right move. I'm not looking for overnight riches. I'm looking at this chart and seeing that every year my wealth quest gets a little faster and a little stronger. While the portfolio value is great for the wealth quest milestones, the real goal is the cash flow. When we look at the annual dividend per holding, you can see exactly where that $701 projected annual dividend is coming from. My top 3 income producers right now are Hershey's, leading the pack with $87.11 a year, Automatic Data Processing close behind at $75.13, and Realty Income contributing $72. These 3 companies alone represent nearly a third of my total annual dividend income. They are the anchor positions that provide stability I need to keep growing. It's also interesting to look at my largest holding, Google. Despite being over 13% of my total portfolio value, it only contributes $11.15 in annual dividend. This is an intentional choice. I'm balancing high growth tech like Microsoft and Alphabet with high yield or high growth dividend payers like Texas Instruments and Starbucks. This mix is what gives me that 2.30% weighted dividend yield. It's enough to feel the compounding effect today without sacrificing the capital gains for tomorrow. Even the smaller contributors matters. Seeing Procter & Gamble or Apple on the list might not seem like much, but every time I reinvest or add a fractional share, like the Microsoft and MasterCard buys I made this month, those numbers tick upward. It's a game of inches, and every dollar added to these total is a dollar I don't have to work for in the future. Now let's get into the part of the spreadsheet most people skip, the actual gain or losses. If we're going to be transparent, we have to look at the red alongside the green. On the winning side, Google continues to be the MVP of this portfolio. I invested $2,262 and it has grown by a massive $2,785. It's essentially a 100% gain. We also saw incredible performance from JP Morgan and Texas Instruments. These big winners are the primary reason the portfolio is sitting at nearly $38,000 today. But like I said in the intro, it's not all sunshine. I have several positions that are currently in the red. Automatic Data Processing missing is my biggest unrealized loss right now with $492. Nike is struggling, down $413, and Hershey's and S&P Global are also sitting in the red. Seeing nearly $500 missing from an ADP position might look bad on paper, but as a dividend growth investor, I actually see this as an opportunity. I'm still collecting that $75 annual dividend from them, and as we saw earlier, I actually added more shares this month. I'm buying quality at a discount while the market is being pessimistic. When you add all up, the winners are far outweighing the losers. This is the benefit of a diversified portfolio of blue chip companies. You don't need every pick to be a home run. You just need winners to run hard and your losers to keep paying you a dividend while they recover. To wrap up the numbers, let's look at the total return percentages. This is where you see the real power of time in the market. Looking at my legacy holdings, the growth is staggering. JP Morgan is officially my best performer at 163% total return, followed closely by Apple and Alphabet. These are the positions that had returned a few $1,000s into the 38,000 portfolio you see today in terms of percentages. Again, sticking to the promise of transparency, not everything is a home run. Nike is currently my deepest laggard at 40% down. ADP and Hershey's are also struggling at 16 and 10% down respectively. In most investing videos, people will tell you to cut your losses and run. But because these are quality companies with strong cash flow, I'm not panicking, except for Nike. I'm holding, collecting the dividends, and as you saw earlier, I'm even adding to some of these positions. I'd rather buy Microsoft at a minus 5% return or S&P Global at a minus 10% return than chase a stock that has already doubled. When you look at this list, you see a mix of aggressive growth and steady income. That balance is what pushed up this portfolio to $37,931 this month and kept us on track for the 100K goal. April was a solid month of recovery, a record-breaking month for dividends, and a great reminder that the slow and steady way works. If you are building your own digital diary or tracking your own road to 100K, keep at it. The spreadsheet don't lie. Consistency is the only secret there is. That will be it for this portfolio update. I'll see you in the next one.